Hi there, my name is Greg Laxton and I'll be highlighting a few key aspects of the 2019 interim results of FirstRand Limited. The group is a high quality bank with a strong diversified portfolio of businesses that boast above industry ROEs and have been showing strong momentum, albeit slowing. Its new initiatives are showing uptake and the group has typically displayed resilience in earnings and income during recessions. The share seems fairly valued, trading on a forward PE of 12.6 times, with a forward dividend yield of 4.6%. The short term may prove challenging for the group due to the subdued economic outlook, as earnings growth is slowing and profits are likely to be constrained, most notably in the lending franchise, which accounts for more than half of the group's income. The strong performance seen during the year was largely due to F&B, which saw strong growth in personal loans, credit cards, and retail deposits. The group has a good track record of providing innovative digital solutions, which should help support the resilience of its lending business. Cross-sell through its digital platforms, which has a low origination cost, should also benefit the group. Credit costs have deteriorated slightly, however the impairment ratio is still below the through-the-cycle threshold. It may prove challenging for RMB to realize earnings growth due to the high base in private equity realizations from the prior period. The continued investments in insurance and wealth are a drag on performance in the short term, but have the potential to drive up profits significantly. Management remains confident in Aldermore despite the uncertainties surrounding the macro conditions in the UK, thanks to Brexit. The subdued macro conditions in South Africa, which are expected to remain for the rest of 2019, the uncertainties surrounding the UK economy, and the potential drag of the insurance and wealth investments on overall performance are all factors pointing to a negative outlook. The group has a cap 6 weighting of 4.35%, and we have a neutral recommendation. The credit loss ratio was 19% higher at 86 basis points due to strong advances growth. However, it remained below the through-the-cycle range of 100 to 110 basis points. The Tier 1 and Common Equity Tier 1 ratio were both up 50 basis points to 12% and 12.6% respectively. The leverage ratio was 30 basis points higher at 7.4%. All these ratios are above the regulatory minimum requirements. The group issued its first Basel III compliant instrument, and together with the Tier 2 bond issued, these are aimed at improving the efficiency of the capital structure. The liquidity coverage ratio was up 700 basis points to 122%, much higher than the 90% requirement. Net interest income was up 8% to 29.05 billion, thanks to solid growth in deposits and advances. The interest income accounted for 58% of total income. Provision for bad debts was up 24% to 5 billion rand, and the adoption of IFRS 9 did not have a material impact on the impairment charge. Non-interest income grew by 7% to 21 billion rand, thanks to growth in fee, commission, and insurance income. Operating expenses were 10% higher at 26.73 billion. Operating jaws for the period fell from 0.7% in the prior period to negative 1.7% in the current period. The cost-to-income ratio was slightly higher at 52.4%. Normalized earnings were 7% higher at 237.8 cents, and the dividend per share improved by 8% to 275 cents. The subdued macroeconomic conditions are expected to remain in South Africa for the rest of the year. Management considers the group well positioned to reap the full benefits of an uptick in growth in the medium to long term. The new initiatives are expected to support the ROE of the group as the rest of the businesses mature. Growth in the UK is expected to slow down due to Brexit. The group continues to target real growth in earnings and superior returns. However, this may prove difficult within the RMB division due to the high level of private equity realizations in the prior period. The profile of the group is expected to remain resilient. The card business within F&B contributed only 6% to the division's normalized earnings. Therefore, any significant competition from Discovery or a time bank should prove immaterial. Before I end off, if you would like to trade, then please contact our trading desk. Investors are reminded that they can refer to our online trading platform, which contains an in-depth analysis of FirstRand's 2019 interim results. For more information on how to interpret the trade idea, visit the events section on psg.co.za to access previous trade ideas and how to understand the method of analysis we use. Lastly, I would like to bring your attention to the following disclaimer. Thank you very much.